Thank you very much, ladies and gentlemen. It's a great pleasure to discuss the Euro crisis here with you. I have worked in capital markets for 20 years, and you will probably notice that the way I look at issues is shaped by that experience. Over the last good 20 years, I have lost a bit touch with academic life and with textbooks. Instead, I've been in daily contact with people who every day, every hour, have a lot of money to either gain or lose in financial markets. And that does shape the way I feel. So if some of the things I say may strike you as being not academic or different, you can put that down to my interesting or my particular experience in markets. One of the things that we learn in markets is markets are not rational. Markets summarize the information of human beings. And for many purposes, it makes sense to treat human beings as being rational. But there are instances when human behavior, especially when it comes to the behavior of groups, does defy at least the normal logic of what one would call rational. Put differently, panics are rare, but panics do happen. There are sometimes self-reinforcing destructive dynamics. Just like once in a while we do have irrational exuberance, we do have panics. And the big lesson that I have drawn from the Euro crisis is it does take a lender of last resort to prevent or stop a panic. Normally, you don't need a lender of last resort. Normally, the interaction of people in markets produces results which look fairly rational. But once in a while, we do need a backstop. Among the things I've also noticed is, over the last few years, that there is a gap between the public and academic discussion of issues on the one hand, and the way issues are discussed and treated in financial markets. As well as there is a big gap often between the debates in different countries on the same issue. For instance, one example of the gap in perceptions is oceans of ink have been spilled on the issue of Greece over the last 3-4 years. In my view, Greece was never very important. For markets, the last 4 years were not about Greece. They were always about contagion. And if there's one thing I would like to drive home in this speech this morning is, when you think about the Euro crisis, think contagion, not Greece. Think matters of confidence. What makes people buy or sell assets in markets? Think of confidence and don't get too hung up with precise details of debt ratios or debt sustainability calculations, which have changed so much and are so susceptible to what you put into the calculations that often they strike me as meaningless. The gap between facts and the readiness to see facts is also sometimes extraordinary. For example, in this country, Germany, we have a raging debate about inflation risks coming out of the financial and the Euro crisis. I've never understood that debate. The one thing that is least likely to happen in the wake of such a financial crisis is inflation. You may get loads of other things, but in the wake of financial crisis, the liquidity preference of everybody is elevated. That is, you need a lot of extra liquidity to just satisfy the demand, the precautionary demand for liquidity. It is not easy to get inflation out of that. And what has also struck me as interesting in the debate over recent years is how often the word moral hazard has been used in the debate, usually without checking whether there's actually any evidence for moral hazard. After these preliminary remarks, let me get into some charts and then into my story of the Euro crisis. First of all, among the things I never fully understood is why people call this a debt crisis, the experience of recent years. If I look at public debt in the Eurozone since the start of the Euro and compare the evolution of public debt ratios to the US and the UK, the Eurozone has had half the increase in its public debt ratio than of what we've seen in the US and the UK. Before Lehman, the Eurozone actually had a debt to GDP ratio below the level where the Euro started in the beginning of 1999. The Eurozone, in my view, never had a debt crisis. Greece had a debt crisis, and it still has a debt crisis, and a very serious one. But the fact that we actually, over time, fell into a systemic euro crisis which seemed to threaten the existence of the Eurozone, that is not really about public debt. Otherwise, the US and the UK, and of course Japan, should have had the crisis, not the Eurozone. It is also not that the Eurozone is just such a weak, fragile economy, so that small things, even a small increase in public debt, could put the venture at risk. Even on the labor market, if you take a bit of a longer-term perspective, comparing the Eurozone to the US, the performance is not that different. In terms of the number of jobs created since the start of the Euro, the US and the Eurozone are roughly on par. The major reason that the US looks good with an unemployment rate of 6.7 versus 12% for the Eurozone, the major reason for that actually is that the participation rate in the US has fallen, whereas it has risen in the Eurozone. The point I want to make here that many of the discussions I have seen about debt and the perennial weakness of the Eurozone have always struck me as odd, because I could not really match them with the facts. What the crisis, in my view, really was about, the systemic element of the Euro crisis, was this. It was a central bank crisis. Outside the Eurozone, it's pretty clear. There is a lender of last resort, the National Central Bank. If the going gets rough, if there's a panic, or if there's just a whiff of panic in markets, the central bank steps in massively. In the Eurozone, we did not have a lender of last resort. More precisely, we did not have a lender of last resort willing or allowed to admit that it actually is the lender of last resort, the ECB. What you see on this chart is the size of asset purchases until about a year ago by the ECB, the Fed, and the Bank of England. It's obvious where we did have effective panic control in the US and in Britain, and where we did not in the Eurozone. So, to me, the Eurozone crisis was not and is not a debt crisis. There are less fiscal problems in the Eurozone in aggregate than we have in the US, the UK, or Japan. The Eurozone had one and only one big institutional defect. There was no lender of last resort. In early 2010, we suddenly needed a lender of last resort. That was when Greece got into trouble. We've already heard why and how. After some back and forth, we then, in May 2010, came up with a little lender of last resort, this EFSF, this fund, supported by some limited bond purchases by the ECB. The result of that, of the May 2010 decision to basically have a fund that was supposed to be 750 billion euros, the result of that decision was that the euro crisis, more precisely the Greek crisis, remained fairly contained. From then onwards until the middle of 2011, we had economic growth in the Eurozone roughly at its trend rate. We had economic growth in Germany that was close to boom conditions. With this provisional, small lender of last resort, the EFSF, we had managed to contain the crisis. The crisis was in Greece, and then when we had a bit of a discussion about collective action clauses in bond contracts, the crisis spread to Ireland, and a little later to Portugal, but it was 3 small countries at the fringe of the Eurozone which had a crisis. Until the middle of 2011, the region as a whole had been successfully protected from having serious contagion problems. And then came the big mistake. And that was, in the middle of 2011, the decision to restructure Greek debt. I lived through that in financial markets. Initially, when Mr. Schäuble mentioned that in a Handelsblatt interview, nobody took it extremely serious. There was not much of a market reaction. But when, by the end of June 2011, markets realized Europe means it, they actually want to restructure Greek debt, markets started to become very jittery. The formal decision to restructure Greek debt was taken in the middle of July 2011. Over the month of July, bond spreads, yield spreads for Italy and Spain over Germany widened a lot. Investors rushed out of the paper. It was not about Greece. They sold Italy and Spain. They had already sold Greece. And in August and September, equity markets across Europe tanked. There was a bit of equity volatility at the same time in the US. We had this funny debt ceiling debate over there. But if you look at where equity markets were the end of September 2011 relative to middle of the year in the US versus the Eurozone, you see that this was largely a Eurozone event, a European equity event. As a result of those turbulences, the Eurozone economy fell almost straight from trend growth into recession by the end of 2011. The German economy fell from close to boom conditions into stagnation by the end of 2011. It was the spread of contagion from Greece to Italy and Spain, and then the fear factor striking the entire region that in a way caused the euro crisis. One effect of the euro crisis, the spread of contagion, was that German businesses stopped investment in Germany. This was not about Greece. This was a general fear. This was contagion. Even the really healthy parts of the Eurozone, Germany, were affected massively by what you could call the confidence shock. I'm actually not saying that restructuring of debt or default should not be done. We did it for Greece, and it was a mistake. But the real mistake was to not think through the consequences. It is only safe to do a restructuring, to break the promise given to bondholders in May 2010 to make them whole on Greek debt. It is only safe to break such a promise if you have a backstop. That is, if you can impress upon everybody that this will not happen, this breach of trust, in Italy and Spain, in big economies. We did not have a lender of last resort in the middle of 2011 that could have credibly said, or did credibly say, this is an isolated Greek event, the debt restructuring over there. Then we had 1 year from the middle of 2011 to the middle of 2012 in which the Eurozone sank ever deeper into recession, in which leading indicators were going down, and not just for Greece, for Germany and the region as a whole. We had 1 year in which the ECB tried almost everything. They cut interest rates. They had a massive liquidity injection, these 3-year LTROs, as they are known among the monetary experts. We had the European Central Bank buy bonds under its SMP program, limited in size and temporary, as the bank said. And nothing of that helped for more than a few weeks, or at most 2 months. Despite the ECB doing almost everything, panic continued to spread, the region continued to fall into a recession. Then came Mr. Draghi at the end of July 2012, speaking in London, saying, "We are the lender of last resort. From now on, the European Central Bank intends to behave like normal central banks, namely be the lender of last resort." From then onwards, everything in the Eurozone went up again. Leading indicators went up about 1 or 2 months after Draghi spoke. The economy reacted to the monetary stimulus. De facto, Draghi restoring order in markets enabled the transmission of monetary policy through banks and markets to the real economy to work again. About 9 months after Draghi spoke, the Eurozone economy returned to growth, and that growth has been firming ever since, modestly, but firming. In the debate, I've often heard over recent years that the Eurozone has many institutional defects. In my view, there was only one, the lack of the lender of last resort. Everything else, including issues in the banking system, are serious but are of second order. The Eurozone actually is different from other regions of the world in very interesting ways. Within the Eurozone, we now have a mechanism for internal solidarity, but it's very different from national mechanisms. Because in the Eurozone, it is the creditors, the strong ones, who set the conditions for solidarity with the weak. In a nation state, it is the strong and the weak together. It's the creditors and the debtors who, through the national political process, set the conditions. In the Eurozone, it is the German parliament, de facto, which sets the conditions for Portugal to get support if need be. As a result, the conditions for support within the Eurozone are much tougher and probably much more efficient than anything you will ever find in the German Länderfinanzausgleich. Once in a while, I would like to see a troika from the Bundesbank, the finance ministry, and perhaps the BDI being sent to the Saarland. So, we have a transfer mechanism in the Eurozone, but it's conditional credits with tough conditions, which as an economist I find much more efficient. Also in the Eurozone, we have a central bank that is uniquely independent, that actually got away with letting the economy slip into recession for a year, from mid-2011 to mid-2012. Why is the ECB such a hard-nosed creature? Very easy. This is the most independent central bank in the world. They don't have a finance minister. They have 18. They don't have one national parliament which could change their mandate. They have 19 parliaments, including the European Parliament. It is impossible to change the mandate of the ECB in practice. Why? Because a change to the Maastricht Treaty would probably have to be ratified by a referendum in Ireland and Britain. Forget about it for a while. As a result, the ECB is more independent and can afford to be more tough-minded than other central banks. It can afford, to some extent, to let a crisis happen, as, to some extent, a crisis can serve a purpose of forcing change. What I would now like to do briefly is go through a few slides here. First of all, showing what I said about the Eurozone economy. This is when Draghi spoke. We had a downtrend. This is pretty much the Greek debt restructuring. A massive downtrend in leading indicators, and now a serious uptrend in the Eurozone and the periphery, basically in lockstep. Draghi, the ECB, changed everything. That's what I mean. All other debates, banking union, whatever have you, are second order. What broke the trend was the European Central Bank. Only the central bank can be credible as the lender of last resort when it comes to big issues, such as protecting a big country, Italy, against contagion risks. We have serious adjustment progress in the euro periphery. And that's what I would like to show you a couple of graphs now. One easy way to capture the adjustment progress of the crisis countries is this. It's the twin deficit, the current account deficit, and the structural fiscal deficit, which was extremely pronounced a while ago and now is almost in balance. This is the current account of the 5 crisis countries. It excludes Cyprus, too small and too recent. And you see, from a major deficit, we've moved into surplus. And that holds for all individual crisis countries. They now are no longer living beyond their means if you measure that in terms of the external accounts. A massive adjustment. The adjustment is roughly half, the external adjustment, stemming from a fall in imports, and the other half stemming from a rise in exports. Basically, as you would expect. We have serious changes in unit labor costs. The red bars going that way to the left mean fall in unit labor costs relative to the Eurozone average since 2009. And an indicator by the OECD of how much structural reforms are really happening. 1 would be the best possible, 0 would be nothing, has a very clear result. At the top of structural reforms in the entire OECD area in recent years are, well, Greece, Ireland, Portugal, Spain. That's not an accident. They weren't given a choice by the Troika. They have to do it, and they do it. That is what I mean when I see discussions about moral hazard. Moral hazard is a theoretical risk. But when I look at the data as to moral hazard in the euro periphery, I see that those countries that have received external assistance have not fallen prey to moral hazard. Instead, we see massive adjustment progress. Overall, we've summarized at Berenberg various measures of adjustment into one overall indicator where 10 would be the best possible, and Greece, Ireland, Spain, and Portugal top the list of adjustment on labor costs, on the fiscal side, on external adjustment, and structural reforms. Details, we can send you the report. It's an 80-page report if you're interested. There is good news even on the Eurozone labor market. A leading indicator of the labor market, the red line, projects gains. Year-over-year employment in the Eurozone is still falling, but it's no longer falling very much. It's starting to turn up. And if you look at quarter-on-quarter change in employment, the last quarter of last year, have a guess where we have the strongest employment gains recently in the Eurozone. It starts with Portugal, goes on to Ireland, then come to small fry, and then we're at Spain. A bit below, roughly on par, Germany and Greece. That may be oddities, quarterly data. I don't want to read too much into that. But my point is, even the labor market in the crisis countries seems to be turning. And another point, the clear discrepancy between core doing okay, periphery doing badly, is no longer there in the data. The euro crisis, thanks to the ECB stepping forward as the lender of last resort, has receded, not just in markets, but we are seeing the economic turnaround in the crisis countries, which I would now call reform countries, including that turnaround spreading to the labor market. I don't want to take much more of your time. Let me summarize a few points before I hand over to Volker Clausen. The first point I really want to stress again is the one deficiency of the Eurozone was the lack of a lender of last resort, the lack of somebody who could impress panicky investors that the world is not going to end tomorrow, or more precisely, that you're not going to lose most of your money in Europe tomorrow. We needed a lender of last resort to stop a panic. The purpose of a lender of last resort is not to bail out the bad. The real purpose of a lender of last resort is to protect the less bad against contagion risks. Again, this was never about Greece. This was always about the risk that something being happening in or being done to Greece could cause a systemic crisis, could cause trouble in Italy, in France, and Germany. And a little side note before I stop. Another lesson I've learned over recent years is that austerity is a potent medicine, but it has to be applied in the right doses. If we have as much austerity as we had in Greece, the economy tanks too much, and debt sustainability is impaired rather than improved. And a related lesson that if I look at the performance of countries at the Euro periphery, I see that those with most structural reforms are the ones which now do better, whereas those which had a focus on austerity initially are doing less well. So austerity is necessary, it shouldn't be overdone, and more important than austerity are the labor market reforms, as we have seriously in Portugal and to some extent in Spain, and as we had 10 years ago in this country. Thank you very much.